make sure you're normalizing your P&Ls when you're underwriting a deal. And here's what I mean by that. When you take a look at a business or a property's expenses, you're going to find expenses that aren't actual expenses of the business that shouldn't be there, or expenses that should be there that are missing. So we need to make sure that we have everything. So I'll give you a quick example, like personal auto expenses, insurance. This is not business insurance. Personal insurance is added as an expense on the business books or the P&Ls. A big one that you'll see is depreciation. Now, I understand why they have depreciation there. It's a tax saving strategy, but that's not an actual expense to the business. Sometimes you'll see several $100,000 into depreciation added as an expense that we can actually add back in, increasing the NOI and the performance of this property. Owners paying themselves. That's a huge one. I've seen properties where the expenses were 70, almost 80%, and it's because it's full of a lot of crap like this that isn't an actual expense to the business. Maybe they built new buildings on the property last year. Well, that's not an operating expense. That's a CapEx, a capital expenditure. It's a one-time expense. It's not reoccurring, so we can take that out. Personal mortgage, travel, utilities that are outside of the business. So if you are looking at P&Ls and something says miscellaneous or other, you need to ask the seller, what exactly is that? What's that money going to?